Welcome back. We are now in chapter 15, and in this chapter we'll be considering a fourth case study, this time on working capital assessment using cash budget. So far we have discussed three case studies, right? One is regarding a term loan, other is also regarding a term loan. This is a fresh term loan, right? This is a review of term loan, okay? Term loan that was sanctioned a couple of years back, and then we have reviewed whether the project was completed or not, and other aspects like margin and other aspects. The third case study we have discussed about a working capital, a request for working capital enhancement, which this was a trading company that has applied for enhancement of limit from 3 to 4.5 crores, right? We have seen a complex case in the sense that there was the current ratio was less than 1, right? Here also the second example also we had a diversion of funds. So we are seeing complex cases so that you are familiar with such cases, right? If everything is fine, that doesn't require a lot of focus from the point of view of credit officer. But we have looked at complex cases so that when you come across those situations, you can spot them, okay? And then you know what to do, and then you can take a decision as to what needs to be done, right? So in this final case study, we'll be discussing also working capital request, but this time we'll be considering cash budget, okay? So in this example, if you recall, we had arrived at the MPBF based on second method of lending, the regular procedure, right? Holding levels, because it's a regular this is a account that is a trading unit, okay? Trading or manufacturing, you'll be considering the MPBF method, the second method of lending, where we assess the holding levels and calculate MPBF accordingly, okay? But there are certain activities as we are going to see shortly that requires a different approach, where this holding levels approach is not applicable, okay? So we'll take such an example in this chapter, right, and assess the working capital eligibility. So you'll be coming across a number of proposals where banks will be receiving requests from contractors, okay? So contractors usually are small term contractors, right? Most of your proposals for contractors will be around less than 5 crores. You know, the limit will be requested around 50 lakhs or 25 lakhs, small limits, right? 1 crore, 2 crores. Most of them will be below 5 crores. So these are small time contractors, right? Even if it's a big contractor, the procedure will be same. But what I'm trying to say is you'll be coming across a lot of these small proposals, okay? Where the contractor will be undertaking small contracts for government departments, like local municipalities, road works, right? Large projects will be large contracts anyway will be construction of bridges and those sort of large projects, okay? But there'll be small maintenance contracts, small civil contracts, right? So there are a lot of borrowers engaged in that sort of an activity, right? And this activity, it is not manufacturing, it is not trading, right? This is a very peculiar sort of activity where the normal method which we consider till now, that is holding levels and MPBF method, is not going to be relevant, right? The reason being that the inflow and outflow of funds is not going to be uniform. Right, if you think about a normal manufacturing company, right, where that it's a continuous operation. By and large, every month you're going to see a same level of turnover, right? Say for example, a company is a 25 crores turnover company, right? Every year is generating a turnover of 25 crores. If you see that around 2 crores every month, you will see a turnover. You will observe a turnover of around 2 crores every month. It's not going to be 2 crores every month. Maybe in 1 month it will be 1.8 or 1.9 or 2.1, 2.2. There will be a variation, but by and large it will be around the same level, right? Because the activity is same, right? The capacity is same, the manufacturing process is same, everything is same, right? Unless there is a wild fluctuation in the demand due to seasonal factors. For a normal unit, you will observe that by and large every month the sales will be same, the expenses will be same by and large. I'm saying by and large, okay? But in this case of activity, in this contract activity, that's not going to be the case. Okay, here there will be wide variation in the monthly receipts, whether it's receipts, that's the turnover, and the expenses. There will be wide variation, right? So if you drop a month-wise starting from April to next year March, right, a 25 crores turnover might look completely different. It's not going to be 2 crores or around 2 crores every month. It might fluctuate very rapidly. It might be just as low as 25 lakhs in the first month. You know, it might be 1 crore in the next month, 1.25, 2. It can go up to peak in some months. It's going to be peak at 3 or 4 or 5, and then maybe it will again come down. We don't know what is the pattern, but there will be wild fluctuations. The point is, it's not going to be same. The turnover in each month, the receipts in each month, you cannot compare. There will be wild fluctuations. The total will be 25. right? But then there will be wild fluctuation within each and every month, and that's the nature of this activity, right? The nature of the activity is the contractor will be executing work against an order. There will be a work order, right? And every month upon the construction of the work, he'll be raising what is known as the RA bill. Okay. Now this is based on the progress of the work, and the progress of the work need not be same every month, right? And this bill, once it is raised, it will take time to realize into cash, because most of this work is done for government departments. There will be delay in processing this bill, and once the cash comes back, there will be a lot of delay. So this is a very peculiar sort of activity, right? This is a different sort of activity where we need a different approach for assessment. Okay, what is done in the cash budget method of assessment is we arrive at what is known as peak deficit. Okay, this is nothing but the maximum deficit, maximum gap between receipts and payments. We sanction this peak deficit as the working capital element. Now remember, this deficit might be for just for 1 month, right? We do the assessment for 12 months. Okay, we calculate we estimate what could be the likely peak deficit for each and every month in each of these 12 months. Okay, so for 1 month maybe we think that the likely receipts is going to be 2 crores, whereas the expenses this company might increase around 2.5 crores. So there is a deficit of 50 lakhs. Okay, similarly we try to estimate what could be the likely receipts for the next 12 months, what could be the likely payments for the next 12 months, and we arrive at this deficit, or in some months it could be surplus, we don't know, it can happen, right? We arrive at these figures for the next 12 months. So in some months there will be deficit, some months there will be surplus, and for the next 12 months we'll be assessing the likely deficit and surplus in each and every month. Whichever is the highest deficit, that is what is known as peak deficit, that we sanction as the working capital limit. We will see that shortly in an example, but that is the methodology. Okay. So you need to be comfortable with this cash budget, because you'll be getting a lot of requests from contractors for OD limit, right? And for this activity we are not going to use the MPBF method, right? We are going to use the cash budget. So let's take the example of a contractor, and for simplicity let us assume this is a new firm with no past financials. So we'll start with a fresh set of projections. JKL is a new proprietorship firm, right? Promoted by Mr. Verma. He has earlier worked in a firm which executes government contracts, and he has developed good contacts during his earlier stint. Okay, now he started his own firm, and the firm is engaged in the execution of contracts for the local municipal corporation, right? So it participates in tenders and gets the works. Okay, presently it is having work orders on hand of around 80 lakhs. Okay, and accordingly the contract receipts for the next year is projected at 100 lakhs, which looks achievable, right? Even though the current financial year 12-13 only 6 months are left, most of these contracts might be taking less than 6 months, right? Say around 3 to 4 months. So the orders on hand are 80 lakhs, right? Orders, they'll be bidding in the contracts, so bidding in the tenders, so 100 lakhs seems achievable. Okay, so for this execution of these orders, the firm has applied for fund-based limit, OD limit of 30 lakhs and BG limit of 10 lakhs. Okay, BG limit is required for furnishing BGs in lieu of deposits. Okay, and the firm is offering security of 50 lakhs. This is not relevant to us for the credit appraisal. This is at the time of taking a decision, right? Sometimes banks will be having a policy guidelines, like say contractors SOD against real estate to contractors will be the minimum security is 150%. So then it will come into picture. Okay, but for the moment our appraisal is not concerned about security. Right, let us look at the CMA data submitted by the company. So this is the projected profitability statement. There are no existing past financials. This is a new company. So we have three. This is for 6 months. The first year is only 6 months, because already 6 months have passed the current financial year, and this is for the 12 months. So the company is projecting receipts from the contracts of 100 lakhs for the first year and 225, and this is the profitability. Okay, this is the projected balance sheet. These are the liabilities and these are the assets. Right? Again, no past financials, 3 years projections. Okay. So in these sort of accounts, borrowers, besides the projected P&L account and projected balance sheet, they'll also be submitting what is known as a projected cash budget. Okay. Now this cash budget will be the basis for our assessment. Now please note that bank cannot prepare this cash budget. Okay. So in the case of an ordinary company, that is not a contractor. Okay. Once we are given the projected P&L account, projected balance sheet, you yourself can prepare the MPBF. Okay. Because the method is a standard procedure. But in the case of this cash budget, we cannot prepare this statement, because this is a month-wise statement that lists out projects the cash inflow and outflow. Then this depends on the nature of activity that is that is specific to the company, and this is something which only the company can prepare. We can prepare as a banker, you can prepare, but that will be a rough estimate, right? Banks insist for the company applying for OD limit to submit along with P&L account and balance sheet. They'll also insist on submitting a cash budget. Okay, so let us assume this company has submitted the following cash budget. Usually cash budget will be submitted in the bank's format. Banks will be having their own format, but by and large this will be the items. Okay, so there will be something called receipts, right? So these are the receipts. Usually it is the income, the major portion. If there is any capital infusion, it could be usually it is income, and then all these are expenses. Okay, so income minus expense you'll be calculating for each month. Say for example in the month of November, so for the month of October, the total expected receipts are 5 lakhs. Okay, whereas the expenses are 25 lakhs. Okay, so 20 lakhs will be the deficit. So for example in say Jan, the total receipts are expected to be 12.5 lakhs, whereas the expenses are expected to be 7.7 lakhs, and in this month there will be a surplus of 4.7. In some other months there could be deficit like -2, so it will be varying, this deficit, right? As a cash budget submitted by the company for 2012-13. Okay, similarly the company has submitted cash budget for the next year also. So this is cash budget for 13-14. Again, income, expenses, deficit, surplus or deficit for each month. Okay, so now let us try to understand what you need to understand about cash budget. Okay, so for example we'll take the financial year 13-14 and then we'll look at the cash budget. Okay, the first thing that you need to observe is that income is not uniform. This we discussed earlier. Okay, income in this sort of activity, in this sort of contracts or any other business, any other activity where you're going to use cash budget. Cash budget is not just for contracts. It's any business where the inflow and outflow is not going to be similar. It could be seasonal industries like sugar. Okay, real estate, right? Builders who are engaged in construction of flats and all. In those cases also there will be we use cash budget. Okay, rice mills. Okay, so seasonal activities or contracts and real estate, you'll be using cash budget. Okay, so the defining feature of those sort of activities is that the income is not uniform every month. So let us take the 2013-14 cash budget, and immediately you can observe that the income is not same across all years. It's a wide fluctuation. Okay, in some months, in October, November, it's going to be as low as 5 lakhs. Okay, whereas other months is varying from 17, 20, 21. Okay, so this is going to happen. Okay, so this sort of variation is going to be there because the activity is like that. Why so low in these 2 months? Maybe this company is engaged in some outside work. Okay, so where rains could be delaying rains could be adversely affecting the work, right? So maybe these 2 months in the rainy season, somewhere in September, October, November, usually if they're engaged in outside work, companies will be projecting a lower turnover in those months. It will be varying, okay, depending on the activity. The point here is it's not going to be uniform across all months. Similarly, the expenses is also not going to be equal across all months. So what the cash budget then does is it will calculate the difference between receipts and payments. As we have seen, in some months there will be surplus, in some months there will be deficit. If you look at say this month June, right, the company is expecting a receipts of 17 lakhs, whereas the payments put together is 19 lakhs. So this is a deficit of 2 lakhs, 2.63. Okay, so this is the deficit. Whereas in the next month in July it's expecting a receipts of 20 lakhs, whereas expenses is only 15.89. So there will be a surplus of 4 lakhs. So this will be varying. In some months there will be a deficit, in some months there will be a surplus, right? So what the company will be doing is it will be drawing from the, so whenever there is a deficit, the company will be drawing from the OD account in months where there is deficit. So whenever there is a deficit, that is in months where the expenses are more than the income, the company will be drawing the deficit from the OD account. Okay, so you can see this is the first year of operation. New company, no past financials, starting in October. For the first month there is a deficit of 20 lakhs. The company is expecting more expenses than income. This is the first month. Obviously the receipts are going to be very low, right? In fact there are no receipts because this is the first month, and the billing cycle usually takes 2 to 3 months. So the company is expecting the bill to be realized in December for the work done in October. So first month is not going to be any income. So this is a capital infusion. Okay, so this deficit of 20 lakhs. Okay, so you have sanctioned an OD of 30 lakhs, say, starting from 0. Okay, so the company will be drawing this deficit from the from the OD account. So the OD balance goes to 20 lakhs. In the next month, there's no surplus or deficit. Next month, no surplus or deficit. In the next month, the company, that's in January, the company is expecting a surplus of 4.71. Now this 4.7 will be credited to this account, and the OD outstanding will come down from 20 to, this is the closing, okay? It will come down to 15.29. Okay. In the next month, again, there is some deficit of 2 lakhs. So again, the company will be drawing the 2.33 from the OD account. So this will be increasing to 17.62. So it will be going on like this. Basically, the point is, in months where the expenses are more, the company will be utilizing from the drawing from the OD account. In months where the income is more than the expenses, it will be credited to the OD account. So in the example of June 13, we have seen that the receipts are 17 lakhs, whereas expenses are 19. So there will be a deficit of 2.63. So you should understand that this is not going to be the OD limit, because this is going to vary. In some months it's going to be deficit, in some months going to be surplus, and this amount itself is going to be varying, right? So what bank will be doing is it will be calculating the peak deficit, right? In the year 12-13, if you see, for all the months it is this, right? In year 13-14, peak deficit is 30 here, 30 here, 30. Peak deficit is 30. In any 1 month, whatever is the maximum deficit, that will be sanctioned as the OD limit, and that will be the fixed as a ceiling. That doesn't mean in every month the company is going to utilize it to the full extent, right? The actual drawings are going to be determined by the cash budget submitted by the company. The company should submit cash budget every month. Okay, so the bank will be getting the cash budget, right? So if in the current month the company is expecting a surplus, say of 5 lakhs, then the drawings will be only up to 25 lakhs, right? Now one more thing that you need to remember is, if you add up the items in the cash budget, okay, if you add up the items of each and every item, any item, say for example income, if you add up the income for the 12-13, you know, the cash receipts, you're going to get around, this is 50, right? This is 25, 40, 50, right? You're going to get 50 lakhs. One mistake that credit officers do is they compare the total of the cash budget for the full year, these items, right, with the P&L account or balance sheet of the company. Now that is not entirely correct, right? Because there is something called accrual system of accounting, which we discussed in the very beginning chapter, right? The first couple of chapters we discussed that, right? So this is not going to be exactly same. If you look at the P&L account projected for 12-13, look at the P&L account projected for 12-13. The company is estimating a 100 lakhs as per the projected P&L account, but whereas in cash budget we are seeing only 50 lakhs. Now don't ask the company why there is a difference, right? And that's not a very smart question, because it's not going to be same, right? That's precisely the reason why you ask for cash budget. To know about this difference, you're asking cash budget. Now if both these statements are same, you would not require a separate statement called cash budget, right? So the company, yes, you can say the turnover is 100 lakhs, but the company has received only 50 lakhs in cash. Now what happens to the 50 lakhs balance? It will receive in the next year. So it's normal, it is possible, right? So the company has completed the work by March, okay? By March 13, the company has completed the work. It has raised the RA bill, but the amount was not paid by the government agency. It is possible, right? Because the processing, the time for processing the bill will be taking time, right? So where will that 50 lakhs balance, 50 lakhs will be reflected? In debtors, obviously in debtors. So if you go to the projected balance sheet, there you'll easy. This is the projected balance sheet. Look at the item called debtors. Under assets, receivables, you'll find that 50 lakhs. Similarly, let's take another item. So let us look at another item. Any item, let us take material, okay? You add up the material for all these 6 months, you're going to get 33.34, okay? But if you go to the P&L account for 12-13 and look at the materials, it's 40 lakhs. So in the cash budget is 33.34, whereas in the P&L account is 40 lakhs. What is the reason? The company has paid in cash for the material of 33.34. It is yet to pay the balance of 6.66. Why it did not pay? Because it is creditors, right? The creditors has given time, say 30 days or 45 days to pay. So as on March 13, this is not paid. It will be paid in April or May the next year, right? It will be paid in the next financial year, okay? So where this will be reflected? 6.66 will be reflected in the creditors. So here it is reflected, right? Sundry creditors for 30. So don't always try to compare the total month-wise total of the cash budget and compare it with the P&L account or balance sheet. It's not going to be exactly the same because due to the accrual system of accounting. But once you adjust for that accrual system of accounting, those will be same, right? So with that, we come to the end of this chapter. You'll be comfortable with the cash budget. Okay, you'll be getting a lot of small borrowers, small contractors, and then you have to be for this these sort of limits. Generally, this is known as these limits are known as under a broad name of SOD against real estate for contractors. Now this is the name of the facility usually used by banks. Okay, we call it SOD because it is secured overdraft. Right, this overdraft will be backed by some security, right, against real estate. Usually, urban or semi-urban property will be taken as security for this limit. Okay, and it's for contractors. Similarly, we can have SOD against real estate for builders. So banks will be having their own facilities, but basically this is the methodology in those sort of companies. Okay, right. So with this we come to the end of this chapter. In fact, we come to the end of the 4 case studies we have discussed. Hope you have got a broad idea as to what are the points you need to look into while processing a term loan proposal or a working capital proposal. In the next chapter, we'll be discussing about credit concepts. Okay, the various terms you might come across in your in the advances related work. Okay, so see you then.